There's nothing else like it out there. So when people say, oh yeah, what else can I do like 1031? There's nothing else you can do like 1031. It's that unique.
All right. Hey guys, welcome to another Ultimate Edge webinar series. This time I'm excited and delighted actually to have Kyle Williams with us. He's going to talk about 1031 exchange. A little background here. I did a couple of 1031 exchanges about a year and a half ago now, maybe a little somewhere in there. And Kyle, I don't know the right word, just facilitated those transactions for me. That was really helpful. Thank you, Kyle, for doing that. He used to work for another company, and Kyle changed recently from the facilitation unit they used to work for to a new company. And I'm interested, first of all, Kyle, why the change? What happened there? What prompted that?
Yeah, good question. The 1031 industry is unregulated, and it's tough for companies to not take shortcuts and actually do things by the book as they should be. What we do differently here is that we don't commingle funds, right? Funds are put directly into a trust account from escrow, like their trust account is on the settlement statement, which means that they have to sign off on any movement of funds. So funds are never commingled with other funds. We can't abscond funds. There's limited opportunity for us to even do anything except send the funds out for what the client requests, which is a wire for their purchase. Also, the 1031 industry by and large lacks transparency. What we do differently over here is that we actually have created a portal where clients can log in, view their account, view their bank account 24 hours a day, 7 days a week. So
that's good.
Yeah, as a lender, you know this, John, sometimes like you'll need proof of funds on a Saturday or on a weekend. Now clients can just log in and get that 24 hours a day, 7 days a week. They don't have to wait for us to type a number on our letterhead and say, there it is. We'll actually give them a bank account statement. So
I like that off the top. I will tell you, Kyle.
Yep. Really cool. And fees are a little less too. So it's just, it's hopefully the way the 1031 industry is shifting towards a more, client-friendly, ethical approach.
Okay, good. I'm judging by the slide that we see on your screen. The name of your new company is Velocity 1031. Is that correct?
That's correct. Yep. Absolutely.
Pretty perceptive of me, huh, Kyle?
Yeah, that's good. Good catch.
Well, the fact that Kyle alerted me with an email prior to when we were chatting about the work, so that helped too.
Yep.
Kyle, I know you're going to do a presentation here. I suspect you're going to define what a 1031 exchange is for those on our YouTube audience in particular that may not know. Is that correct?
Let's
look at that.
There, John.
Let's do it, Kyle.
Awesome. And please jump in because we have about 35 minutes or so,
yeah.
Right, John?
Yeah, that'll be fine.
So are we going to, I would prefer if people ask questions as we go so they don't get lost.
I was just going to mention, guys, those of you on the webinar right now, you can use the chat feature or the Q&A, either one, and put a question in there. I'll monitor that as we go and ask Kyle questions as we move along.
Perfect. Yeah. And again, there's no continuing education. There's nothing except knowledge out of this. So John set it up for you guys to build your knowledge base on 1031s and to ask questions. So please don't hesitate to ask questions. If I'm going through something too quickly, if I'm not explaining something clearly, please jump in and ask questions as you guys have them.
And to those of you on our YouTube audience, if you're watching the video afterwards, go ahead and put a question in there. We monitor that and we'll get answers to you from Kyle or ourselves, whichever is appropriate. Yep. So with that, Kyle, let's go.
All right. So what is a 1031 exchange? A 1031 exchange allows an investor, a taxpaying entity to sell their investment property and use all the equity. That's the key phrase I like to use, all the equity, not just the after-tax equity, to reinvest into something bigger and better, right? Your financial picture looks completely different at the end of the day when you don't pay taxes. When you're deferring those taxes in a 1031 and using all your equity to reinvest, you can really build wealth that way. 1031s have been around a long time. People say, well, it's not really a true exchange, right? Because if I'm exchanging cars with John, what are we doing? We're swapping, we're trading cars, right? A 1031 exchange used to be a deed swap, hasn't been that way for a long time. Since about 1991 or so, the IRS came up with a lot of the rules that we see today. So it originally used to be a deed swap. That's where we get the word exchange from in 1031 exchange. But now most exchanges are three-party exchanges. I'm the exchanger. I'm one party selling to a second party, buying from a third party. So it's no longer a true exchange. Exchange motives. So why do people exchange? Cash flow? Largely age dependent, right? Like retired people that aren't working anymore. What do they care about? Cash flow. Big reason. Appreciation. Kind of the opposite of cash flow from an age standpoint, like younger millennials that just bought their first rental. Why are they buying investment property? They're hoping for appreciation. They don't care about cash flow. They want it to cash flow enough to cover the loan and what have you, but they're really worried about appreciation. They want to hit the home run. Whereas someone who's retired and owns investment properties, their number one goal is probably not price appreciation over the next 20 or 30 years, right? Depreciation, being able to actually update your depreciation schedule, write off a larger amount on your taxes. I'll talk about that in a minute. Conversion, being able to convert your investment property into like a dream home or primary residence for that matter. Professional use. So this is an interesting one. With professional use, you'll have investors like, say, a dentist, and he or she may own 2 or 3 investment properties. They can actually sell those investment properties, do a 1031 exchange into like a retail space or commercial space where they start paying rent to themselves because they put their business in. They get the tax benefited appreciation. So business owners on the call, if you own investment properties, that's a common reason we see people exchange. And lastly, going passive. There's actually ways now where you can sell your investment property and exchange into something that's 100% passive. We hear about the terrible T's a lot, termites, trash, tenants, all that stuff. And so someone said rotten R's recently, and I added that. Rodents, renters, and relatives.
That's kind of rough that poor tenants get linked in with rodents. I mean, that's rough, Kyle.
Right. So you'll have people that just want to get out of that active management and go passive. There's ways to do that, and I will talk about that towards the end.
Okay.
So depreciation, basically just a tax write-off. I'm not going to get too far into the weeds because we're a little pressed for time, but depreciation is basically just a tax write-off based upon the value of the structure, the improvements, if you will, of your property. And you can write that off over 27 and a half years if it's residential, 39 years if it's commercial. So let's look at an example here, because this is what everyone wants to know is why would I do a 1031? Like, what's the value here? Well, if you sell an investment property, let's say that you've owned a rental for 10 or 20 years, right? And you've depreciated, you've got a gain. What's your tax rate going to be? Well, money's taxed differently, but a collective tax rate of 25% is not uncommon. Like that's back of the napkin math people will use. Washington state excise tax is always paid, but you defer state tax in other states. For example, if you've got a property in California, when you sell that investment property, you'll defer the state taxes applicable in California as well. So let's look at an example here. Let's say that we sell a duplex in Everett that we've owned for a number of years. We sell it for $800,000 and say we're paying 25% in taxes. If we don't do a 1031 exchange, we'll only have $600,000 to reinvest. And at a 75% LTV, if we're putting that down on a new property, buys us $2.4 million in new property. You guys can see where I'm going with this.
Yeah.
If we sell that property for $800,000 and do an exchange and defer all our taxes using the exact same amount of leverage, that $2.4 million turns into $3.2 million just because we did a 1031 exchange. Think about the price appreciation over the next 10, 20, 30 years on that $3.2 million property versus $2.4 million. Not to mention all the additional income we'll receive, additional income on $800,000 of property. So this is why when you see people say, oh yeah, I built wealth through 1031s by deferring my taxes, this is what they mean. This is how they've done it.
That's huge.
Yeah. So even if someone says like, oh, Kyle, that makes sense, but at the end of the day, I'm not really eliminating taxes. What am I doing? Deferring taxes. And we all had a grandpa who said 2 things in life are inevitable: death and taxes, right? Yes. Really only one of those is, because guess what? The taxing is not inevitable because your heir is going to step up in cost basis. So when you die, you can pass on at the federal level about $12.5 million worth of stuff to your heirs tax-free. That is awesome. So taxes die with you. And we tell investors, don't cash out. Just exchange into something that better hits your goals, whether that's appreciation, cash flow, whatever the case is. Just exchange into something that better hits your goals. So there's a popular 1031 phrase that people like to use just to make sure you never forget this concept. It's called swap until you drop. Kind of morbid, but you probably won't forget it now. Awesome.
I don't think I remember that phrase on the last presentation we did. Kyle, you're stepping it up a little bit. I like that.
Thank you. Okay. Like kind, another common question I get, Kyle, I'm selling this land. Does that mean I have to buy more land? I've heard about this like kind thing when I've done some research on 1031s. It doesn't. Any type of real property held for business or investment use is exchangeable. So there is no difference to the IRS when it comes to 1031 exchanges between land and the Space Needle. It's the exact same thing. They're both investment properties. So if you're a landowner, and John, I don't know if we have any landowners on this call, but
I know that we do. Yeah, a couple of people on here do own land, so that's a good appropriate thing.
Yeah, so what landowners, and there's plenty of good reasons to own land. This is definitely not disparaging land. I own land. There's good reasons to own land, but when it comes to land, you're not getting any income from the property. Yeah, if you're farming it or leasing out, sure, you're going to get some income, but you're not getting the tax benefit of depreciation, which is really the number one tax benefit to owning investment real estate.
Right.
But if you're sitting on a big gain in land, like you've owned land for a number of years, you have a big tax gain, chances are there's been a broker or two that have approached you and said, Mr. and Mrs. Landowner, I've got a buyer that would love to give you top dollar. And you think to yourself, what am I going to do? Cash out and pay taxes and buy something that's just as expensive? I might as well just keep this land. You can actually do a 1031 exchange into something like rentals or into something passive, where you start getting that tax benefit of depreciation and you get competitive income. Most people and most landowners don't know you can do that. So yeah, definitely an idea. If you're a landowner, feel free to reach out to John or myself, and I'll talk more about this. But all these things are essentially the same thing to the IRS. You can exchange out of your rentals, buy water rights, for example, sell out of your cell phone towers, buy land. I mean, it's pretty wide open, and 30-year leases actually work. So if you wanted to buy a 30-year lease, ground lease for like a Taco Bell or something similar, that would work because it's actually like-kind property. So then the question is, well, it seems like everything is like-kind property. So what's not like-kind? Well, everything else, which would be like partnership interests, stocks, bonds, bills, notes, Bitcoin, things like that. Personal use properties don't qualify because they're not investment properties. Flips don't qualify. New builds and developments to be sold don't qualify. And houseboats don't qualify. But people say, well, wait, why don't flips qualify? Or, if you're just building a property and selling it, that seems like an investment. Why is it not investment property? Well, the IRS has said that you need to hold with long-term intent for business or investment use to do a 1031 exchange. So with flippers and builders, there's no intent. Their business is, buying and selling as quickly as possible. There's no long-term intent to hold for business or investment use.
So Kyle, can we pause here for just a moment on this like-kind stuff? I had some clients talk to me prior to the webinar knowing it was coming up. First of all, on the flip thing, just to clarify, let's say the flip takes a long time, 2 years before you finally get done with that thing, and then you want to sell it. Does the time frame matter at all there?
So it technically doesn't, but I'm going to actually give you a scenario similar to that though in a few minutes.
Okay, well, we'll wait for that scenario for that one. And then back to the water rights and stuff. You can actually purchase water rights and potentially mineral rights and not own the land, but own the rights to those. And that's a 1031. Do I understand?
Yeah, correct. It's treated as fee simple property. And that's one thing, even though 1031 is federal tax code, that varies by state. So kind of a broad rule of thumb, and this is not exact, but Basically states west of the Mississippi, water rights, timber rights, probably qualify, mineral rights qualify anywhere, but if you're west of the Mississippi, water rights and timber rights would probably qualify, but like, timber rights will qualify in Georgia, or in Oregon, but in Georgia, for example, they don't qualify.
Oh, okay, got it.
So yeah, it's just if we have any farmers or any ag people on the call, we do. I've done exchanges for people who own water rights and say like Eastern Washington or Wyoming. So it's definitely doable if they wanted to get out of those and exchange into something else.
All right, and here's one specific example that one of my good buddies asked me about. He has a boat, and it's kind of a mini yacht. It has a toilet, has a place to sleep on the boat, and he's a commercial captain. So he's talking to a seller of a property that the seller understands that they conceivably can do a 1031 exchange, and a portion of the funds from the sale can be used to buy real estate, and a portion of the funds can be used to buy the boat. And as long as the boat is used for commercial purposes, that qualifies for 1031. Is that correct?
It is not correct. So boats technically used to qualify under personal property 1031s, but that went away a few years ago. So now only real property, only things taxed as real property qualify for 1031 treatment. So in the houseboat example, the houseboat itself is not taxed as real property. It's personal property. Therefore, it's not exchangeable. But the slip itself, that's what's taxed as real property. That's what would be exchangeable.
Okay.
Yeah.
All right. I think that answers those. Thanks, Kyle.
Yep. Good questions. So there's the same taxpayer requirement. So that whoever the taxpayer is on title that sells also has to buy. So if Bob's Bricks Incorporated sells, Bob's Bricks also has to buy. Bob himself can't buy because then that's a different taxpayer. So whoever's on title for the sale has to be on title for the purchase.
Okay, can I interject a question there?
Yep.
A single entity LLC. So I have an LLC. I'm the only member of the LLC, and I sell a property that's owned in the LLC, and I want to buy another property, but the bank will not give me a loan in the LLC. They'll only give me a loan in my name. Does that qualify?
Yes, because it's the same taxpayer. John Murphy and the John Murphy LLC, which is one member, are the same taxpayer. So that would work.
Good. I wanted to clarify that.
Yep, good question. Okay. So personal residences, this is just most people own a primary residence. This has nothing to do with 1031, but I like to make sure everyone understands. If you live in your primary residence 2 of the last 5 years, you can get $250,000 tax-free if you're single, $500,000 tax-free if you're married, and you can take that every 2 years. So this is why, like some builders, for example, will build a home, live in it for 2 years, sell it, do it all over again. It's because they keep taking advantage of this $250,000 or $500,000 tax-free. What you may not know, though, is that if you had to sell due to like financial hardship, medical hardship, divorce, unforeseen circumstances, whatever that means, broad definition, you can still get a prorated share of the $250,000 or $500,000, but you'll ultimately want to discuss with your CPA because it's nothing that you would need us for. It's all self-reporting on your taxes, so you'd want to work with a CPA.
All right. Can I interject a question with a person I know? It's kind of a personal kind of question. So they lived in their home for years, and then the kids moved out. So they made an ADU downstairs, and they started renting the ADU downstairs while they lived upstairs in the same home. Okay.
Yep.
And then they said, well, what the heck? And they bought a property in the Sun Belt, and they moved down there. But he comes up to the house all of the time and lives in an RV, which is sitting right beside the house, and uses the residence address there in the RV because it's right beside the house. But they rented out the entire property now. So if they sell that property, and it's been rented out now, Kyle, for probably, I think, 5 years. If they sell that property, does any of the exemption amount apply here, the 250 to 500,000, or would it all have to be a 1031?
Yeah, it does not, because they have to live in it for 2 of the last 5 years. So it would be a 1031 property.
Okay, so let's say they lived in it for 2 of the last 5 years. How does that change the equation? Does it change it at all because of the rental on the property? That's really my question.
Yeah. Then they could still get the 250 or 500,000 and then just exchange whatever the balance is.
Oh, they could.
Yep.
Good to know.
Yep.
Okay, thanks.
Absolutely. Yep. Okay, so buying your dream home using a 1031. So if you've got investment properties, let's say you don't want to manage those anymore, but you'd like to sell those and convert them to a dream home or a second home or primary. You can actually do that as of 2008. So we use a quick example here. John and Sally Smith have retired. They own 4 rentals in the area and they want to exchange for their dream home in Palm Springs. They can do that in a 1031 as long as they rent the new property for at least 14 days a year for each of the first 2 years and limit their own personal use to 14 days a year less each of the first 2 years. So that's a really cool thing where if someone wants to sell out of their investment properties, do a 1031 exchange, it can't be directly exchanged for an investment property, but after 2 years, they can move into it and do with it whatever they want. So there's a way, if you own rentals, for example, if you want to sell those and do a 1031, defer all the taxes and buy your primary residence, you can do that. You just have to wait 2 years to move in. And what people will do is that'll be their forever home or second home, and they'll never sell it. And then eventually they'll pass it on to their heirs tax-free.
I love that. I think that's awesome.
Yeah.
I have a question around the 14 days while we're parked there for just a moment.
Yep.
If a person sells a property and buys another property and it needs some work, and they decided to move into the property to complete the work, and it took them longer than 14 days, let's say they were there for a month and they got the work done and then it was rentable, can they qualify still for the 1031 and you're okay with that?
Yeah, I think that's fine because that's business use, but we would always encourage people, like if you're going over the 14 days, make sure your CPA knows because, some CPAs are very, very finicky about what business use technically is versus personal use. So I'd say it's probably fine, but definitely a situation you'd want to talk to a CPA about and make sure that they're comfortable with the language and what you're doing.
And would it make sense to document the rehab, the work, whatever you're doing to the property in that period of time?
Absolutely. Yep,
Yeah.
100%.
Okay. Thanks, Kyle.
Yep. I'm gonna skip through IRS red flags. Okay, so we talked earlier about home builders and flippers, developers, like why don't they qualify? There's no long-term intent to hold for business or investment use. So John, you brought up an example earlier about someone who buys a property, owns it for a couple of years, doesn't live in it, doesn't really rent it out. It's vacant. It sounds like it's vacant, right?
Okay. Yep.
So there's a case kind of similar to that that I heard about a number of years ago, and I think the couple, they held it for 3 years, and they thought they were getting a smoking deal on the property. The day after they closed on that purchase, they relisted it and jacked up the price. And it sat there vacant for 3 years. And they had taken it off the market, put it back on, done some improvements, and eventually they had a small gain, and they did a 1031, and they got audited, and I think the IRS had questions around what their intent was, and they found out this is a flip. Like their intent day one was to flip the property, and so their 1031 was thrown out. Not only did they lose the 1031 treatment, they could have gotten a fine or some sort of penalty leveled for trying to do that. So we've seen people get unsolicited offers too. Clients that have held for 7 or 8 months and they've already got tenants in there and they're like, hey, I got an offer from a developer who's buying up the city block. I got X for it. I've been offered X. I'd be crazy not to take that. I can do a 1031, right? Probably. Many CPAs will say, listen, your intent was not to sell the property. Your intent was to hold it long term. You just got an offer that anyone would say yes to. So of course you can sell it and do a 1031 exchange. So there's a lot of gray area around here. Definitely something to loop a CPA in on if you're unsure, but it really boils down to intent.
Kyle, let me ask a question around the CPA thing. You and I have talked about this in the past, and that answer comes up a lot. Talk to your CPA and make sure it's good with them. What if your CPA says, nah, I don't think that's probably going to hold true for a 1031. I think you have a problem there. And you go to another CPA and they say, yeah, I think you're good. And so you go with that CPA. Is the burden of responsibility on the CPA because they were the one that consulted you and said it was okay? Or do you have problems?
Yeah, how liability it would be divvied out in that situation. I mean, they sign your tax return, but you also sign your tax return, right? Like they prepare it, you sign it. It's what the CPA can deem as defensible. Ultimately, the punishment is going to lie with you. But some CPAs say, I can defend this if there's an audit issue or anything that arises, I'm comfortable with this position. So I mean, you are taking some risk. They're not going to go to jail for you or pay your fine for you, but it's just a matter of how comfortable they are with taking that risk.
Okay.
How comfortable you are.
Yeah. So it comes down to you're liable because it's your 1031, even if you got advice from the CPA you relied on that was bad advice.
Yeah. I mean, I don't know like how CPAs can necessarily be disbarred like attorneys can be disbarred. I don't know how specifically in a case like this, if there was a fine levied, like how a CPA would. I don't know, John.
Well, yeah, I wondered about that. That's cool.
You're personally taking on liability. How much you think you can get out of your CPA by taking him or her to court? I'm not sure.
All right, fair enough.
Yep. Okay, so basic rules and timeframes. Day 0 in the exchange, close of escrow. That starts a 45 and 180-day clock. Make sure your exchange is set up before close of escrow. I cannot stress that enough because once you've closed, it's too late. So if there's anything to remember today, make sure you set up your exchange before close of escrow. I can't stress that enough. There's different identification rules to use. I'm not going to go through these because we could spend 20 minutes on this alone and end up down some rabbit holes. But basically, there is a rule that will work for no matter what you're doing, whether you want to buy one property or portfolio of properties. There's an identification rule that will work for no matter what you're doing in your 1031 exchange. In the 1031, so if you ever hear the word boot, it just means taxes. So in this case, examples of getting taxed in a 1031 exchange could be the headline for this. In 1031, you want to do two things: buy for equal or greater value and reinvest your proceeds. That's it. That's all you have to do. So if you sell for 700,000 and there's no loan or anything, and you get 700,000 back, as long as you buy for 700,000 and reinvest all your proceeds, you'll have a successful exchange. Let's say you sell for $1 million and there's a $400,000 loan on the property. As long as you buy for at least $1 million and have 600,000 in proceeds reinvested, you'll have a successful exchange. The last one, kind of unrelated to the two, but not buying like-kind property. So if you bought a business, like a gas station, for example, not all of that is technically real estate. So you'd want to make sure the real estate value is equal or greater to what you sold for. Mixed use exchanges real quick, duplex. So even if you live on part of the property, it doesn't prevent you from doing a 1031 exchange, because in the duplex, like if I live in one half and rent out the other half, the half I live in, I'll take the 250 or 500,000 on, and the half I rent out, I'm going to do the 1031 on. So it's truly mixed use. Yeah. Mother-in-law unit. Typo. So if you guys have an ADU in back, and literally if your mother-in-law lives there and doesn't pay rent, then yeah, you can't exchange that. It's personal use. But say you rent it to like a college student or something, that's exchangeable. That's investment property. Old Victorian, like down in Seattle, like say Northgate, you'll have, and this is relatively common now, someone that has like a 3,200 square foot, 5-bedroom Old Victorian, and they live in 1 bedroom and rent out the other 4. Most of that house is going to be exchangeable because most of the house is technically investment property. So even if you live on part of the property, if part of the property has investment use associated with it, it's actually exchangeable.
Good.
So you can exchange between all 50 states. You can't exchange out of the United States, but you can exchange foreign property for foreign property. So if you want to sell in Seattle and buy in Phoenix, you can do that, or sell in California and buy in Washington, you can do that as well. I'm going to skip through this. That's a long story. Reverse exchanges. So if you want to close on a purchase first, It's technically doable, but there's some complications to it. In the reverse exchange, we actually have to take title to the property. So you can't get a traditional or like what's called a conforming loan for the property. You need to have cash or hard money because, again, we're taking title to that property. They can be considerably more expensive. A normal 1031, it's less than $1,000. Reverse exchange would be at least 4,000 or 5,000, if not more, depending on complexity and costs and stuff. So we try to tell clients, listen, if you can close on your sale first, great, that's the way to go. But if you need to close on a purchase first, that's what the reverse exchange is for.
Good. I'm glad you touched on that, Kyle.
Good. Good. So real quick, Delaware Statutory Trust, DST. So this is that passive real estate option that I talked about. So DSTs are portfolios. I mean, it could be a single property, it could be a portfolio of properties like Dollar Trees and FedExes and Walgreens, things like that. But you actually have to, you can actually exchange into these. So if you wanted to go passive, say you've owned investment properties forever and you want to exchange into something passive, you can actually do that with Delaware Statutory Trust. This is obviously not a solicitation. That's not a current offering, but there are financial risks. So you have to work with a licensed financial advisor, and definitely something to loop a CPA in on, because we don't guide clients or advise clients on replacement property. So you have to do your own due diligence and, again, work with a financial advisor for something like this. All right. Okay, as we wrap up here, I covered this with John about what I really like about working with Velocity 1031 is that there's a lot of transparency. Like, clients can view their account 24/7. That's basically unprecedented in the 1031 industry. And the fact that we don't commingle funds, that we put funds directly from escrow into a trust account that shows up on the settlement statement to verify that that's where they're going, is also something that's relatively unprecedented in the 1031 industry. So two things: transparency and safety of funds, super, super important for us. But what do we actually do? What does a 1031 company do? We're like another layer of escrow. We hold funds in a safe and secure manner. That's what Velocity does, safe and secure. But we work with everyone in the transaction. So if your broker needs something, we'll work with title and escrow. If the CPA has questions, we'll work with them. But doing a 1031 is relatively straightforward. Your job, just finding new investment property. So there's my contact information. John, any questions, anything that I covered too quickly?
Well, great information, Kyle. Tammy has a question, and I think you've answered it, but I'm going to allow you to speak specifically to it. Is it not true that we can only buy a single-family home if we sold a single-family home in a 1031 exchange, and multi for multi?
Correct. That is not true. You could sell land and buy rentals, for example. You could sell commercial and buy cell phone towers. As long as the property is held for business or investment use, it's exchangeable between any of those real estate asset classes.
All right. And Kyle, I get this question a lot. So you had a slide there that talked about red flags that the IRS has. Maybe you can just speak to it now. I don't know if you need to go back to the slide. But what does the IRS look for, and what should we not be doing or whatever, so that we don't set ourselves up for an audit here that we don't want to have?
So, yeah, let's see if I can pull this up here. Let me go back to that slide. So these are not my own. This is what I've talked to CPAs about, read about, taking higher than average deductions or losses. So if you make $300,000 a year and yet somehow you get your taxable income down to $11,000, the IRS is probably going to suspect, something's going on there. You're probably writing off stuff that you shouldn't be writing off, or you've taken a very liberal definition of what a write-off is, or what a tax benefit is. History of rental property losses, that's kind of an interesting one, because the IRS has said that there's no business purpose to consistently losing money except to generate tax losses to offset gains. Filing a paper return. This is interesting because I know quite a few people, especially, older people, that still file paper returns. There's nothing wrong with that, but I think the odds, I think I heard that you're 16 times more likely to make an error, if you file a paper return as opposed to doing TurboTax or working with a CPA, because you may be honest and ethical, but every one of us on this call makes errors from time to time. We all make mistakes, right? The IRS knows that, and they know that there's a much higher chance that you fat fingered a number or incorrectly reported something, even if you're being honest and ethical. So again, this is not an exhaustive list. The IRS doesn't specifically talk about, they're not going to put out a list of everything that they're going to look at. But this is just kind of what I've read, what I've talked to CPAs about, is just broad level things.
Good. Kyle, I know you and I've had a couple of times we've done presentations. This was awesome. Good information. Awesome. I really appreciate it. Two things. One, I'll give you a chance, two closing thoughts for the second thing. The first thing is you told me a story one time in one of our presentation thing about a lady who did the tax 1031 exchange to buy a home. And if she would have waited 2 years to move into the home, she would have been just fine, but she didn't wait 2 years and bad things happened. Do you remember what that was? And can you relate that, please?
Yeah, that was a Cheryl Savage case. I think it happened about 10 years ago, but she did an exchange from some investment properties into her dream home overlooking the ocean. And Cheryl didn't wait 2 years before she moved in. She just moved in early and made personal use out of the property, and she ended up going to federal prison for 14 months. She pled guilty and everything and still went to federal prison for 14 months. So we'd encourage everyone, follow rules, follow guidelines. The IRS doesn't, they don't take kindly to blatant tax fraud and tax evasion. So, I tell everyone the same thing. Like, if you're unsure about something and it's a gray area, talk to a CPA, because I can't tell you definitively what the IRS is going to look for. I'm not your CPA. I don't sign your tax return. So therefore, again, if clients are unsure, I can answer a lot of questions, but there's plenty of gray area because much of the tax code is gray area. So that's why it's important people have a good CPA they can reach out to and ask questions to.
Yeah, absolutely. So in Cheryl's case, I'm sure they disallowed the taxes, so she had to pay the taxes, and there probably was a penalty on top of that and 14 months in prison?
I think she ended up with almost maybe $1 million fine. And the 1031 was disallowed. I think the fine was $750,000 or $1 million. So just trying to push a 1031 through, you can obviously end up in big trouble. So it's not to scare anyone and say, oh yeah, this is going to happen to you. She broke the rules knowingly, right?
Yeah.
And so most 1031 exchanges, like, you have 45 days to identify. We're not going to let you identify on day 46 or day 47. Like, we're going to keep you out of trouble as much as we can. On our end. But if you're blatantly doing something to break the law, there's nothing we can do about that.
Yeah. Don't mess with it, guys. That's the moral of that story.
100%. Yeah. The IRS rules are more than fair around 1031s and like moving into investment properties and stuff like that. So we tell everyone, just follow them. The IRS rules are definitely more than fair. They could have said, no, you can never move into a property.
Right.
You only have to wait 2 years. So just abide by it and you'll be fine.
Yeah, and the benefits are so significant if you abide by it. I mean, it's just worthwhile. Don't put yourself in a situation where they're going to disallow it. It just doesn't make good sense to do that.
Yeah.
Kyle, some closing thoughts? Anything you want to wrap up with?
Yeah, no, 1031 it's a very unique part of the tax code. I'm going to stop sharing. It's a very unique part of the tax code. So there's nothing else like it out there. So when people say, oh yeah, what else can I do like 1031? There's nothing else you can do like 1031. It's that unique.
Yep. And I would suggest to you that you definitely want to work with people here that know what they're doing. That would include your CPA. That would include somebody like Kyle. You saw his contact information there. I know from personal experience that you can reach out to Kyle and chat with him about your particular situation. He'll answer your questions right up front so you can make some good informed decisions, which is the right way to do these things, guys. Feel free to reach out to me for any loan questions. We work together, Kyle and I, when we do stuff like this. So we're happy to service you. Kyle, awesome information. As I said, thanks once again for joining us. I really appreciate it.
Okay. Yeah. Thanks, everyone. Take care.
All right. Take care, guys. Bye-bye.